My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. People make friends, just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CBC or tweet me at Jim Cramer. The grand pivot is upon us, and a lot of people are having trouble processing it. That includes today, where the Dow advanced 138 points, S&P dropped 0.27%, and the Nasdaq tumbled 1.34%, all part of the pivot. I'm talking about the fact that inflation is already peaking, courtesy of the Fed's decision to raise short-term interest rates quickly while selling off its huge hoard of bonds in the future, most likely jacking up long rates at the same time. Suddenly, demand is softening, while supply is getting more plentiful for a host of goods and for homes. Now, as is often the case, people want to fight the Fed. Right at this moment, they can't bring themselves to believe that the party might be over. The party and the companies that have benefited the most from inflation. Think commodity producers are the highest growth stocks that are valued on cash flow or orders. Yeah, like the ones found in the now beaten down Nasdaq. Any company that's been raising prices with alacrity will soon be a stock you don't want to own. And they'll probably have to roll back those prices, unless it's something that's impacted directly by the war in Ukraine. They are like food or fertilizer. Even those are coming down a bit, though. At the same time, consumers will be the winners, whether we're talking about regular people buying stuff from a store or manufacturers buying inputs for their products. The stocks that can fly in this environment have been in a bear market for ages. They are now being freed from their shackles, and a new bull market nose is happening as we talk. Meanwhile, the stocks that had been leading us higher for years, a very narrow group, think FANG, the acronym I came up with, narrow, 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 I think can bounce, was really slaughtered this week, but ultimately are going to get hammered far more than they already have been. If you want to see a living, breathing explanation of the pivot, please join the CNBC Investing Club. A lot of people did in the last day, just to watch yesterday's monthly club conference call. The whole pivot is laid out there in a very visceral fashion. How do we know what works and what doesn't work in this situation? You only need to look at history. As I started saying on this show in November, it's curtains for everything other than the companies that make real things or provide real services at a profit and then return some of those profits to their shareholders via dividends or buybacks. The playbook has worked so far so well, and I bet it will keep working now that pricing for so many important things is already peaking. And that concludes freight, as I told you this week, and packaging and homes. In this environment, you need to own companies that make stuff and do things profitably. But let's add also with stocks that remain cheap on a price-to-earnings basis. With that in mind, what's the game plan for next week? Well, first, on Monday, we need to consider if there is anything that could change the flow of the war in Ukraine. That conflict has jacked up the price of oil, but also all sorts of foodstuffs. Those are the remaining areas of persistent inflation, and it's worth having exposure to them in your portfolio because I don't think this war is over anytime soon. Second, we have to keep our eyes on the long bond. Now, this time the 30-year Treasury. Not something we've previously discussed in the show, but we better start now. The 30-year, not the 20, is where all the action will be once the Fed starts selling its bond portfolio. You need to know that this sell-off in the 30-year is signifying that much higher rates are on the way. Get ready for them. Higher long rates will likely hurt the Nasdaq, like we saw today, not the Dow, which can hold up just fine because it's full of tangible companies that fit my criteria and my mantra. Tuesday starts ugly. It's with the Consumer Price Index, which doesn't yet reflect anything peak. So you have to expect another red-hot reading. It'll be inexorable and nasty until we see the peak in everything. Whatever the so-called consensus is, it's almost always too low right now. And so that's going to gaff the bondholders and put pressure on the stock market that day. Also on Tuesday morning, we get two important reports. First, there's Albertsons, which I think will be terrific, kind of like Kroger. They should also spell out whether they're going to try to take themselves private or announce some sort of special dividend or big buyback, because they did say something's going to happen. Now, we know Kroger's been on fire because its price increases are sticking. I think the same thing's going to be happening at Albertsons. Hey, how about price increases that may not be? Well, but have been for a while. and that's CarMax, used car heaven. The used car market has been one of the great inflation battlegrounds, terrible battleground if you're the Fed. Because there are so few new cars, these used cars have been bid up to outrageous prices. Any sign that this endless series of price hikes is over, or that demand has been destroyed by how high it is to buy a used car, will reinforce my thesis that all the used car companies must be sold, and the Fed's going to get a pass, finally, on that terrible part of inflation. Here's another very contrary theory about this earnings season. I am now going to offer you a whole new view. You got to own the large banks. See, I got the banks, the drugs. You're starting to talk about a new bull market, aren't I? Yeah. The banks. And not just because their stocks have been crushed. Whenever we see urgent rate hikes, the biggest winners are the large banks with the large deposit bases. Hey, like J.P. Morgan reports Wednesday morning. Now, there's a real thicket here. The capital markets have been horrendous, if not nil, and that could hurt J.P. Morgan's profits, definitely. But every time the Fed raises rates, these guys instantly become more profitable on a risk-free basis. Still, I think that the first move, it's going to open down, and these people are going to look at the capital markets, and they're going to panic and sell, and then you have to start buying J.P. Morgan. Maybe wait till the end of the day. Also on Wednesday, Bed Bath & Beyond reports. The question here is simple. Will big new shareholder Ryan Cohen of Chewy and GameStop fame join the board? And will the bye-bye baby business be sold to private equity? I think it's all on the table, and the stock goes up substantially. What else? We get to find out the secrets of BlackRock's success when it talks on Wednesday. I want to hear more about how individuals might get to vote their index fund shares. See how Larry Fink sets the rules and the agenda for most of the country on these issues. And we got Delta Wednesday. Now, I'm in favor of buying travel stocks because of the great reopening. But the airlines are a tough sell here, given how much money they can lose in a Fed-mandated recession. Bat on shoulder, don't own airlines into a Fed recession. If J.P. Morgan goes higher off these deposits repricing, thanks to the Fed's rate hike, well, then you should buy Bank of America. It's going to take off. This is another one that's been obliterated by the weakness in the capital markets. That means the IPOs, financings. But in the end, Bank of America is a regular bank with a vast deposit base that can make fortunes when the Fed starts tightening. It's going to be one giant earnings race for them in 2023, even as they may have to cut numbers for the next quarter because rates have yet to rise fast enough to offset the lack of corporate activity. Also on Thursday, we hear from Goldman Sachs, and I've never seen Goldman Sachs, the stock this cheap ever. While any stock, of course, can get cheaper, even if it's got a 2.5% yield, I think you're getting a fairly good chance to catch a bounce here, if not an investment, because by this point, it should be no surprise that Goldman's first quarter was ugly. Throughout next week, people will be looking for signs they can play the transports or the semis on any bounce. You must resist the urge to bet on them. It's simply too tricky. Check yesterday's speech. It's just very hard to thread the needle. I don't think most people are nimble enough. I know I'm not with my trust. Now, keep that in mind when you see the coming dislocations, as we realize that demand has suddenly gotten weaker for everything, and something I know I am very early on. Unfortunately, I bet that Loretta Mester from the Cleveland Fed hasn't seen what I'm looking at when she speaks Thursday, as she didn't see in October of 2018. That's why going into the three-day weekend, I fear she'll give us a speech that starts at the close of the market that will be incredibly hawkish, perhaps a rough reminder for those who decided to buy stocks that fight the Fed. But the bottom line, even as the Fed goes on the warpath, we've already seen signs that inflation is peaking in many areas. Unfortunately, so is the rest of the economy. Let's go to Marcus in the land of enchantment, New Mexico. Marcus!
Cramer, what's going on, man?
I don't know. I'm going to take a trip this weekend. How about you?
Oh, awesome. I'm just going to be chilling, talking to you, I guess. Thank you so much for taking my call.
Oh, my pleasure.
Awesome. I have a question for you. I'm a 28-year-old investor with a long time horizon. I have a company that is profitable, has recently pulled back, has a monopoly when it comes to computer-aided design, and just recently ventured into the AR/VR space. Is Autodesk worthy of a long-term hold in my portfolio?
Exactly. Long-term hold, because we're going to have some rockiness because it is in tech, but it is a great company. You're absolutely right. I like the call. Let's go to Thomas in Michigan. Thomas.
Booyah, Jim.
Booyah.
I just wanted to start off with a big booyah. I'm a high school student out of Michigan. My parents are also wealth managers. I'm calling to ask about Coinbase. I know recently with things happening in Russia, with sanctions, over 25,000 accounts plus have been blocked or banned. So just wanted to get your thought on that.
On Coinbase?
Yes.
I don't like them. I think that they are too contrary to what I see is right to have in the banking business. Let's put it as genteel as that, frankly. All right, we're already seeing signs that inflation is peaking. I'm earlier on this, but when it first happens, then you got to make your move, and that's what I'm saying. The rest of the economy is going to get weaker too, though, so you have to be a little more defensive. On Man Money tonight, after reporting an earnings beat, I'm getting a read on the spirits business. Talk about defensive with the head of Constellation Brands. Then retail's been wrecked already, so we're starting to screen 80 retail names to see if any of them are beaten down enough that even if we have a slowdown, you'll do okay. And the oil patch has become the wild, wild west. And I'm learning more about what we can expect for the hot commodity with the one and only Rusty Brazil, the expert. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.